Hey everyone, it's Ben Hardy here, and in today's video we have to talk about how the Federal Reserve is about to meet in the middle of this month and what this is going to do to the car market. Before we get into this video though, as always, if you can save time and money the next time you purchase a car, link to my car buying guide in the description down below. And if you want to see more content just like this, then I recommend you subscribe because I post these videos every single day. Let's get into it. So as of right now, we know two things. First off, the Federal Reserve meeting is in the middle of this month, and it is happening a day after an updated inflation report is going to be released. Now, depending on what this inflation report says will determine what the Federal Reserve will do. If the inflation report comes in as expected, then what everyone is kind of expecting is that the Federal Reserve will raise rates by another 50 basis points. If it comes in hot, i.e. inflation is higher than expected, then we might see 75 basis points, or we might see a whole percent increase in rates. And if it actually comes in cool, then we might be in a scenario where the Federal Reserve doesn't raise rates at all, or maybe it's only 25 basis points. And so there are lots of different outcomes that we have to kind of dive into. But before we talk about how this is going to affect the car market, we need to talk about why this would even affect the car market. And that's because on average, over 80% of people that purchase a car take out a loan on that car. So interest rates are obviously very important. And so if we dive into the federal funds rate, this is the rate at which lending institutions can charge each other if they're loaning each other money. So obviously, if it costs lenders more money to get money, then they're going to charge you more money when they loan it out to you. And so you can see then this would have a direct impact on the car market because if, well, the federal funds rate goes up, then that means that auto loan rates will go up, which means that affordability will go down. And then it happens in the opposite direction if, rates obviously decrease, because then that means that affordability will increase. So let's talk about the first scenario, which is the most unlikely, and then we'll kind of go to the, more likely scenarios. So the most unlikely scenario is that the Federal Reserve lowers interest rates at this next meeting, that they basically find out that somehow they have fixed the inflation problem, so they're going to lower rates. They're going to ease up a little bit. And if this happened, it would actually be really bad for the car market, because although new car availability is slightly better than what it was just a few months ago, it's still not great. And so if interest rates lowered, then that would push a lot of people back into the market, which means that supply would then again be a lot worse, just like what it was like a few months ago and what it was like last year. And so then that would drive prices back up, and that's not what anyone wants. And so yeah, let's hope that scenario doesn't happen. Now, the next scenario is that the Federal Reserve is a little bit softer with their rate increase. Let's say that they only increase by 25 basis points, somewhere around that range. Or maybe they stay at a neutral range where they just don't increase the rates whatsoever. In this case, then what we're going to see is just a continuation of what we're seeing currently with the market, where we're just seeing week over week declines because interest rates are already high enough that it's pushed enough people out of the market that they just simply have to wait until prices fall down enough for them to be able to afford cars at the current rates that we have. And so we would just basically see a continuation of what we're seeing today. Now, let's say that the Federal Reserve raises interest rates by 75 basis points or by a full percentage point with this next meeting because inflation's just still way too hot. This would be absolutely devastating for the car market in the complete opposite way, which actually would be a really good thing for cash buyers, I suppose. So this would just escalate everything that we're seeing currently. And so with the used car market, we would just see the declines increase. And I think that because of how negative buyer sentiment would be with such a big rate hike, it would basically just probably double the week over week declines that we are currently seeing. And so you'd see cars just lose an insane amount of value. I mean, we're talking about, 8 to maybe 10% in value per month if the rate increases get to that point over this next meeting. And so that's, worst case scenario for car values, but I guess best case scenario for cash buyers. And then this obviously would increase availability with new vehicles by a massive amount because again, it would kick more people out of the car market. Now, the most likely scenario is that the Federal Reserve raises interest rates by 50 basis points. This is what everyone is assuming will happen. And again, it's just guesswork at this point. But if this is what happens, then we're basically going to see a scenario where the car market declines at a slightly more rapid rate than what we're seeing today, but not nearly as crazy as if they increased interest rates by 75 basis points or by a full percentage point. And so we're just going to see week over week declines that increase a little bit more. And then again, we're going to see inventory availability slightly increase a little bit more as well. So how can you use this information to help you out as a buyer? First off, when it comes to the used car market, the advice that I've been getting over the last couple months still stands. I would just wait it out because the used car market still has a ton of value to lose before it starts to make any sort of sense. And frankly, even if the Federal Reserve decided to not increase interest rates, I still see the used car market declining because used cars are just simply overvalued. They just went up way too much in price over the course of 2020 and 2021. And so until they are at values that actually make sense in terms of, where they should actually be valued at rather than, crazy market hype, then it'll actually make sense to purchase a used car. So I would just basically start saving car listings and just watch the used car market, and especially watch used car prices after the Federal Reserve meeting, because dealers are going to realize, oh crap, we got to lower these prices because we just lost a lot of potential buyers to this recent rate increase, if rates increase obviously. So just still be patient with the used car market. We need to wait a little bit longer before that market gets to any sort of bottom to where, again, prices make sense whether you're a cash buyer or a finance buyer, frankly. And the reason that I say that finance buyers might want to wait as well if you're looking into purchasing a used car is because even though interest rates will surely increase in the future based on everything that we're seeing within the economy, it's not really going to decrease affordability all that much at this point, because if you increase an interest rate by, let's say, 0.5% on a car loan, because of how short most car loans are, you're looking at a payment increase that is marginal at best. I mean, if let's say you're doing a 5-year loan on a $50,000 car and you increase the interest rate by 0.5%, you're looking at like $10 more per month. Now, obviously, the amount that you pay in total at the end of the loan is going to increase by a substantial amount because that $10 more per month does add up over the course of 5 years. So you obviously want to do the calculations and see how much more money you would be paying in interest. And this is something that's very important because let's say that car values, let's say the car you're looking at declines by, $5,000 in value, but then if you take out a loan on that car, you're going to be paying that extra $5,000 in interest, then it's sixes, right, whether you buy now or in the future. And so you always want to do those calculations yourself, and it's going to be one of those things where you're just going to have to basically take a leap of faith because you're going to have to assume a lot of things. You're going to have to assume that car values won't decrease at a rate that exceeds auto loan increases if you're buying a car now, or if you're going to wait, you're going to have to assume that car values will decrease at a rate that exceeds the increase in auto loan rates. Hopefully that makes sense. I know it was a little bit confusing, but just always do the math and see which one gives you the lower number at the end of the day. When it comes to the new car side of things, it's actually kind of mixed. So I don't really see new car values coming down if interest rates increase yet again. This is going to push some buyers out of the market, but that's actually going to be good for automakers because they're still trying to play catch up for the most part. And so they don't have any incentive to actually lower their prices like with the used car market, where the used car market has tons of availability. The new car market has some availability. So we're probably not going to see any sort of price decreases. However, December might be a great time to purchase a new car because there's a lot of manufacturer incentives being released right now. A lot of manufacturers are trying to just push out as many units as they can to get some sort of reasonable, sales number by the end of the year. So you're going to see a lot of 0% financing offers, and so that's why, considering where interest rates are at currently, it could be a great time to buy. But what I do want to say is you need to really split up the month of December, because prior to the Federal Reserve meeting, you're going to be able to most likely get a lower interest rate compared to after the Federal Reserve meeting. And the thing about manufacturer deals during the month of December is you don't have to wait till the end of the month to get those deals. You can get them at the beginning of the month. And so if you're not going to be financing through a manufacturer lender that's going to give you 0% financing, for example, you're going to do just a traditional lending institution, then you probably want to get it done sooner rather than later, because if you wait until the end of the month because you want to get an end of the month deal and interest rates increase, all of that money that you're saving by getting the end of the month deal will probably be offset by the interest rate increase. And so unless you're a cash buyer at the end of the month, it probably is not going to make sense to wait. That is pretty much going to sum things up for today's video, and I will be making an update video once the Federal Reserve meeting happens and once we figure out if interest rates are increasing, staying the same, or again, potentially decreasing, which is most likely not going to happen. And then I do plan on making an update video once I see some incentives from manufacturers for the month of December to kind of go over, deals that I think are great and you should potentially go for, and deals that I don't think are all that great and are probably not worth going for during the month of December. It'll take a little bit of time to research, but when that video comes out, then, well, make sure you're subscribed because then you'll be able to see it. And anyways, that's going to sum things up. See you guys.